Hello viewers, thank you once again for tuning in. We want to continue doing what we like doing most, remember? And this is your host, Mr. Spotter Fred. Let's continue doing what we like doing most. And this is what? Now, in the most recent session, we talked about capital structure theories. Capital structure theories. And we talked about that these capital structure theories are concerned with two things: whether capital structure affects the value of the firm, or whether capital structure affects the capital structure decision will affect the weighted average cost of capital. As we must have said, just recap of what we said. Theories are concerned on whether the capital structure mix or decision affects A, value of the firm, and B, WACC of the firm. Then we are talked about the theories, the types of theories. One, there is net income approach. That is NIA approach. And with this one was developed by David Durant. We notice that capital structure is relevant. If the capital structure is relevant, then it affects the value and WACC of the firm. That's what we noticed last time. Then two, we have the net operating income approach. 3, we have the Modiglian and Miller theories. Or IA approach, the net operating income approach. This was also developed by David Durant. This is another approach developed by David Durant, which has underlying principle that the application of leverage do not have any influence on the value of the firm through the overall cost of capital. The more application of leverage leads to bring down the explicit cost of capital on one side, and on the other side, implicit cost of debt is expected to go up. How the implicit cost of debt will go up? The more application of debt leads to increase the financial risk among the investors that warranted the equity shareholders to bear additional financial risk of the firm. Due to additional financial risk, the shareholders are requiring the firm to pay additional dividends over the existing. The increase in the expectation of the shareholders with reference to dividends hiked the cost of equity. Under this approach, no capital structure is found to be an optimum capital structure. The major reason is that the debt-equity ratio does not influence the cost of overall capital, which always nothing but remains constant. Now, with this one, according to David Durant, capital structure is not relevant. That is, it does not affect the value of the firm and WACC. That means that the value, according to this theory, the value of levered firm is equal to the value of unlevered firm. The WACC of levered firm is equal to the value WACC of unlevered firm. However, according to this, that the cost of equity will increase as the firm engages more gearing. And we must have come diagrammatically, can be demonstrated this way, that this is leverage or gearing, and this is the cost of capital. Our cost of capital can be the KD. Then we have WACC, but now KE will keep on increasing, but the weighted average cost of capital will be constant regardless of the leverage. And we need to confirm this. We need to confirm this fact that the weighted average cost of capital will be the same in the value of the firm, and the value of the levered firm, and the unlevered firm. Also, the value of the levered firm and the value of a levered firm is the same. We'll want to confirm that accordingly. Now, friends, remember, we may want to use the same question. Now, friends, we consider the illustration we used last time. Now we say example. Using the previous example for NI. We want to see the similarity or the differences. The previous example, consider two firms, X and Y, levered and unlevered. Firms that are similar in all aspects except their capital structure. Both have an EBIT of 900,000 and KE 10%. The levered firm is all equity financed, while the other has debt of 4 million, whose interest rate is 7.5%. So required, using the NOI, determine the value of both firms and WACC. What we have here is the firm X. This is the unlevered. Then firm Y, that is levered. The EBIT, we use the same 900,000. 900,000. This time round, we don't say KE, but let's say that they have the same 10%, 10% WACC. Now the other one was KE, so let's use the WACC. Then we have 7.5% debt. 7.5% debt. This one doesn't have, but this one is 4 million. Now required value of the farm, and proof of WACC. So let's solve this. Let's now using using NOI approach. Let's now try to solve that. Maybe we start with the value of the value of the farm. The value of the farms. The value of the farm, whether levered or unlevered, is going to be, the value of the farm is going to be EBIT over KE. And the EBIT is 900,000. You divide it by 10%, we get shillings 9 million. So according to David Durant in NOI, the value of unlevered farm and the value of the levered farm are the same, that they will not attract any different values. That means that value of X is shillings 9 million and the value of Y is shillings 9 million. Very important there. Let's prove the element of WACC. So we talk about WACC. We should remember WACC of unlevered farm is equals to the KE, the cost of equity. That is cost of equity. And in that case, WACC for farm X is equals to 10%, which is the same as KE. That is okay. But let's look at farm Y. Farm Y, what will be our KE? No, our weighted average cost of capital definitely is the weighted cost of equity plus the weighted cost of debt, 1 minus 3. No, we don't have the tax element at the moment. What is our KE? The KE is simply the EBIT minus the interest over the value of equity. What is the EBIT? 900,000. What is the interest? 7.5% of the 4 million. What is the value of equity? Value of equity, you take the total value of the farm, which is shillings 9 million. You subtract shillings 4 million. The value of debt. So what do you get there? We have the KE is going to be 7.5 by 4 million, 900,000 minus that, then we divide it by 5 million. So we have 12%. So what will be the WACC? Simply we say the value of the farm is 9 million, so the value of equity is definitely 5 million over 9 million. You multiply the 12% plus the value of debt, let me use the 4 million, 9 million by 7.5%. What will that be? So 5 divided by 9, I multiply by 12, plus 4 divided by 9, I multiply by 7.5. So that is 10%. So we have just proved, that the WACC is 10% for both farms, whether unlevered or levered, WACC is the same. What will change? And as you have noticed, what has changed is the KE. The KE for unlevered farm is 10%. The KE for the levered farm has increased to 12%. And that is what you can easily see there. That the KE is 12%, while the KE for unlevered farm is 10%. And you have seen that the more the leverage we use, the higher the cost of equity. That's exactly what we have demonstrated here using this example. Now friends, this is about the NOI. There are some assumptions or critical assumptions of this approach. One, the market capitalizes the farm of the value of the farm as a whole. Two, cost of equity depends on the business risk. If the business risk is assumed to remain constant, then cost of equity will also remain constant. Three, the use of less costly debt increases the risk of the shareholders. This causes cost of equity to increase and thus offset the advantage of cheaper debt. 4, cost. I know you'll enjoy. Keep touch until next time. See you then.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.